There's something the large investors don't want you to know. It's that while an average investor may panic sell during a crash, those that can zoom out into the bigger picture are the ones plucking the low-hanging fruit to make millions from the stock market. Don't take my word for it, because that's exactly the strategy that made Peter Lynch one of the greatest mutual fund managers in history. The clip you're about to watch pack that insight in a way I haven't seen articulated by anyone else, and that's why I'm using them as a jumping board to tell you some things about the current market that you're likely missing. Remember, this is not financial advice, but subscribe to the channel for more discussions like this, and let's get into it.
October has always been a special month. I remember in 1987, I was very, I was very convinced that the market was not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we're going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from, I think, 12 billion to 8 billion. And that gets your attention,
Remember, you're hearing that from someone like Peter Lynch, even when his investment philosophy was stress tested in what's now called the Black Monday of 1987. It was the largest single-day drop in the Dow Jones Industrial Average ever, with the index dropping more than 25% upon the market opening. If someone like Peter Lynch told you to hold it out, or if you believe in the fundamentals of the company, perhaps he'd be laughed at. Now, with the benefit of hindsight, you realize that stock market investing is perhaps a game where you shouldn't even be thinking in time frames below decades. Since Black Monday, the Dow Jones has grown nearly 2,000%, showing an unmistakable steady march upward that lifted any investor that believed in it and had enough patience. Understanding that market corrections and crashes are inevitable on a long enough time frame, Peter Lynch's investment idea advocates a very long-term view on investing while stacking up cash to buy up stock for low when they're being panic sold. And that result speaks for itself. The Magellan Fund, manager by Peter Lynch, became the most lucrative mutual fund in existence, averaging returns of over nearly 29% versus the S&P during the 13 years of 1977 to 1999. There was a lot that happened during that time, with external wars and internal shifts, with the rise of computer trading that introduced even more volatility, and yet that simple philosophy of persistence in the stock market on the big picture dwarfed the panic-inducing market dips and corrections that invariably happened.
The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. As long as the times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year.
The market will go up? That would sound like a naively optimistic statement to someone enveloped by fear during a crash, but as another great investor, Warren Buffett, has said, all you need is enough faith in the economy and the business environment at large to understand that every temporary storm will eventually pass. In that sense, investing in the stock market means taking your emotions out of the equation and committing yourself to a simple yet powerful formula. No matter how far the market crashes, it's going to come back up unless there's something truly catastrophic that questions the survival of the country and the economy entirely. Nothing of that sort is happening. In fact, even if you look at the most recent example with the crash of 2008, the S&P 500 saw the biggest drop in a few months that it had seen in a long time. It was a period of intense panic, with that fear creating a vicious cycle of even more selling in the market. But if you could give someone from that time a crystal ball and show them the S&P 500 in the next decades, they'd likely just hold. From the peak of the crisis in early 2009, the index is now up over 600%, compared to what it was then, with a steady march upward over the years. It's interesting because a formula as simple as this would still not be adopted by a vast majority of people simply because they lack the financial discipline and the ability to override their emotions from making bad moves in the market.
Because a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's now 95, what a buy. Within a year, it was 18. And this is a company with no debt. This is a company, it was just so overpriced, it went down. I did the same thing in my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. How much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now, unfortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do?
It's interesting you mentioned both Polaroid and Kaiser as examples. While both companies are practically extinct, they reveal that trusting the fundamentals of a company goes both ways. While it may be a great solid foundation in your investing journey to look at, it's also important to realize that even great companies doing great financially can also go extinct. Technology and innovation phases things out, and it's important to place your investing philosophy into the larger context of the economy and technology of the time. No matter how great of a brand you make around fax machines or floppy disks today, it's not going to sell. But let me know in the comments what you think about Peter Lynch's ideas on investing in the context of today, because it's hard to deny its massive success in his own career.